Welcome to Min Chao, where law, finance, and real estate complexities are made clear, actionable, and empowering. The information provided on this channel is for entertainment and educational purposes only, and does not constitute legal, financial, or real estate advice. For advice tailored to your specific situation, please consult with a qualified professional. If you'd like to consult with us, please book an appointment through our website. Investing involves risk, and you could lose some or all of your investment. Past performance is not indicative of future results. So whether you're looking to protect your assets, grow your wealth, or make intelligent real estate moves, you've come to the right place. Did you know that back in the 17th century, the Dutch went absolutely bonkers for tulips? Yes, tulips. During what's now known as tulip mania, the price of tulip bulbs skyrocketed to the point where a single bulb was worth more than a house in Amsterdam. Imagine trying to explain to your spouse that you just traded your home for a flower. It's a classic example of a market bubble, showing that even centuries ago, people were getting caught up in the hype. Today, we're tackling a topic that has everyone on the edge of their seats. The next big crash, how to prepare and prosper. Now, before you get too excited, remember this isn't magic, it's strategy. If you've ever wondered how some people seem to come out of market crashes richer than ever, this video is for you. Part 1. Market cycles. A market cycle is the period between two peaks of the market, from one high to the next. It's the natural rhythm of the market, swinging between periods of growth and periods of decline. These cycles are like the seasons of the financial world: expansion, peak, recession, and recovery. How do you know where we are in the cycle? During expansion, you'll see strong economic growth, low unemployment, and rising stock prices. At the peak, the market might feel too good to be true, because it usually is. In a recession, there's declining economic activity, falling stock prices, and a lot of nervous investors. And during recovery, you'll notice the market gradually improving, with cautious optimism returning. Spotting these signs can help you time your investments better. Part 2. Economic indicators. Economic indicators are the vital signs of the economy. Just like your heart rate and blood pressure tell you how your body's doing, economic indicators show us the health of the economy. Let's focus on the big three indicators you should always keep an eye on. First up, we have GDP, or Gross Domestic Product. It's the total value of all goods and services produced in a country, and it's the ultimate measure of economic health. If GDP starts to slow, the economy might be in trouble. Unemployment is another. Rising unemployment often signals that businesses are struggling, which isn't great news for the market. Finally, we have inflation. This is the rate at which prices are rising. Moderate inflation is usually a sign of a growing economy. But if inflation starts to spike, it could lead to higher interest rates, and that's when the market might start to wobble. Remember the 2008 financial crisis? Before the crash, GDP growth started to slow, unemployment began to rise, and inflation was creeping up. These were all warning signs that trouble was brewing. Part 3. Investor sentiment. Investor sentiment is the collective mood of the market. It's how investors feel about the future, whether they're optimistic, pessimistic, or somewhere in between. Sentiment isn't just about numbers, it's about psychology. When investors are feeling good, they buy more stocks. When they're scared, they sell. You can gauge sentiment by checking out market news, social media chatter, and surveys like the AII Investor Sentiment Survey. The AII Investor Sentiment Survey is conducted by the American Association of Individual Investors, AAII. It is like a poll that asks investors if they're feeling bullish, bearish, or neutral. Part 4. Market valuations. Think of market valuations as the financial world's way of answering the question, is this stock worth it? It's all about comparing a company's current stock price to its actual value. If the price is higher than the value, the stock might be overvalued. If it's lower, it could be a bargain. Let's talk about the key metrics you'll use to analyze market valuations. First up is the price-to-earnings ratio, or PE ratio. This compares a company's stock price to its earnings per share. A high PE ratio might mean the stock is overvalued, or it could indicate that investors expect high growth. Next, we have the price-to-book ratio, or PB ratio. This compares the stock price to the company's book value, which is basically its assets minus liabilities. A low PB ratio could mean the stock is undervalued, but it might also signal that the company's in trouble. Part 5. Profit strategies. So you've spotted the signs of a crash, while others are panicking. We're going to explore strategies that can turn a downturn into an opportunity. First, there's shorting the market. You borrow shares of a stock and sell them at the current price. Then you wait, hoping that the price falls. When it does, you buy the shares back at the lower price and return them to the lender. But be warned, short selling can be risky. If the stock price rises instead of falls, your losses could be unlimited. Another approach is to buy put options. A put option gives you the right, but not the obligation, to sell a stock at a specific price by a certain date. If the stock price falls below that level, you can exercise the option and sell at the higher price, locking in your profit. The best part? Your risk is limited to the cost of the option, known as the premium. So, if the stock doesn't drop, the most you'll lose is the premium you paid. Put options are a great way to hedge against potential losses during a market crash. Or you could simply hold on to cash and wait for the market to bottom out. This way, you can buy quality stocks at a discount once the dust settles. Part 6. Calm and wise investing. When the market is volatile, it's easy to let emotions take over. Fear and greed can lead to impulsive decisions that hurt your portfolio in the long run. Staying calm allows you to think clearly and stick to your investment plan. Market crashes can be stressful, but the worst thing you can do is panic. Stick to your strategy, avoid making impulsive decisions, and remember that the market eventually recovers. If you've done your homework, you'll know when to take action and when to sit tight. And when the market rebounds, you'll be glad you kept your cool. One of the biggest challenges for any investor is ignoring the noise. Every day, the financial media bombards you with headlines that can make your head spin. Instead of getting caught up in the daily drama, focus on your long-term goals. The market has its ups and downs, but over the long haul, it tends to go up. So lower the volume of the noise and stay focused on the goal. Investing is a marathon, not a sprint. There you have it. If you found this video helpful, don't forget to hit the subscribe button to join a network dedicated to informed strategic decision-making. Share this channel with others who might benefit from our content. Click the notification bell to stay updated on the latest insights, strategies, and updates. Thanks for watching, and see you in the next video.